It's time for Real Estate 101 with the Karey Brown team from Realty Executives Preferred Advisors.
Good Sunday morning to you. This is Karey Brown, broker-owner of Realty Executives Preferred Advisors, and you're listening to Real Estate 101. I am back today with Dave Hill from Mid-American Bank. Good morning, Dave.
Hey, good morning, Karey. It's great to be with you.
And last week we were discussing homeowners, typically your first-time home buyers, your move-up buyers, things along those lines. And today we're going to hit on self-employed. I know that it's harder just because my husband and I are both self-employed, and so whenever we got our first loan, boy, that was interesting.
Sure.
There's a lot more documentation that gets to go with it when you're self-employed. So you want to kind of touch on what you're asking for people whenever they are?
Absolutely. That's great. Well, being self-employed, of course, it's I don't really look at it as a real challenge of getting approved for a loan. I mean, it's just a different process of how we underwrite it. I mean, we have plenty of self-employed people every day, so to speak, that get qualified for a loan. So, but what are we looking at when we're working with self-employed people? Obviously, it's for example, if let's say somebody has a S corporation or set up, so to speak, and when we're looking at somebody like that, the incomes that we would look at for their net income, so to speak, would be, of course, they might have a W-2, they might have a net from the business, then there might be some depreciation for the business. And we also look for some Section 179 depreciation in those transactions. So we're going to look at all of these sources as different potential incomes for that person. So again, they might have a W-2, they might have business depreciation, they might have Section 179 depreciation, and then, of course, hopefully a net in the business. So we take all of those numbers and we'd add them up, and we want to look at a 2-year average. So if, for example, if all those numbers add up let's just say for the 2014 year, they're $70,000, and for the 2015 year, they're $80,000. So we add up all those numbers, we get 70 and 80,000 respectively. Then we're going to come up with the 2-year average of 75,000. Then we're going to divide that by 12, and then that's going to be your monthly gross income that we would use like any other consumer's income. So it's just a little different way. I don't think it's hard at all. I just think it's a matter of different sets of numbers. It's not like, yes, I get a paycheck every week, and it's real simple. But so a little slightly more work to getting the income approved. I'm trying to think. That would be very true on self-employed. That'd also be true on commissioned people. We look at the commissioned people the same way. We want to see that they have a 2-year history. And you might say, why are we doing this? Well, the key is we want you to be successful with your mortgage. We want you to be able to afford it. And so we're going to spend a lot of time making sure that you can qualify for the loan. The other thing we look at is we're hoping that your business net income or commissions are on the way up instead of on the way down. So I gave you the example of a $70,000 net income for the 14 year and an $80,000 for the 15 year. That's going those trends are going the right way. You're improving your income every year. If it were the opposite way, if you made $80,000 in the 14 year and $70,000 in the 15 year, we would not average those two. We'd actually use the lower of the two. So that's something to think about. I'd say the main thing is if you're self-employed and you want to buy a home, just take your tax returns in for both business and personal, and let somebody give you a general idea of how the income would materialize. But it's not really complicated. It's just a matter of, yes, it's a different process than, I've got a W-2 and a pay stub. So, again, we qualify people every day, not a problem. Let's see. I'm trying to think. Other things that require a 2-year history. If we're going to use your bonus income or your commission income, we definitely want a 2-year history of that. And I think you can see why. I mean, if you're changing jobs, we'd really like to see you with the same employer for that 2-year time frame, so that we know how the bonuses work and we know how the commissions work. And again, we just want to use that 2-year average. And I'm sitting here with Sherry Hunsicker as well, out from Topeka, and she quickly put the note in front of me. How about second jobs? People that have 2 jobs. And we have a lot of people that have 2 jobs. And the key there for us being able to use the 2 jobs for income for you to qualify for a loan is that you have a 2-year history. So if you've got, you've had one job for 5 years and you've had a part-time job for 1 year, then we're really not going to be able to use that part-time job for your income. But if you have a 2-year history of both, then yes, we can use both of those incomes to qualify you.
Good deal. And by the way, she doesn't want to talk on radio, so we're going to give her a hard time. She's just slipping him notes to remind him.
But she looks great. She had her hair done today, and she's looking really good. And
She did. I'm not sure what we look like, but she looks good. So, they do, again, service all of the state of Kansas. Sherry's a lot. She's here a lot in Topeka, and then she also works in Lawrence. So she's a great gal to work with, even though she won't talk on the radio. Okay, so let's talk about the 10 commandments of when you're under contract, the things that you should not do. Number 1, thou shalt not change jobs, become self-employed, or quit your job. Can you explain why?
Well, first, Karey put this list together, and and she has it in her magazine that she puts out periodically, and it's really a good list. It's really good information. And number 1, she's saying don't change jobs. I mean, here's the situation. I guess if you were going from a W-2 job to a self-employed job, for self-employed people, we definitely have to have a 2-year history. So that would be a big change that would really not work for it potentially not work for the type of job or loan you're going into. So highly discourage going from a W-2 type job to a self-employed job or even a commission job. We've had people that are, they've done this type of business for 10 years and all of a sudden now they went on a full commission instead of a hourly or salary. And that makes a big difference as well. So again, we have to have that 2-year history. And by the way, if your employer says, all right, yes, you're 100% commission, but we're going to give you a guarantee or a base, then yeah, we could use a guarantee or base, but just can't use the commission very well. So, and for switching jobs, I've been doing this for 32 years, so I've had about every experience that can happen has happened. And, we've had people that have switched jobs, but the key is staying in the same line of work and hopefully the same money or more money. So it really wouldn't be a huge deal. Yeah, we'd have to do some new verifications of employment if you were switching jobs from company X to company Y, but you're going to make the same or more money. That's probably not a real problem, just a little extra work on our part, which is not a problem. But again, if you took a pay cut or you got into a totally different type of work or a different type of payment system, then, yeah, that would be a red flag we'd have to work with.
Okay, and then the next one is, and obviously it applies to your debt to income also, but thou shalt not buy a car, truck, or van, or you could be living in it. I
never thought of it that way, but basically what Karey's saying is, and what we're going to put on your loan approval, that, your payment ratios can't change. In other words, so we're going to approve you for a loan, and that'll be based on the payment ratios that you qualified for with the loan. And if you're taking on additional debt, whether it be a car loan or, even people spending a lot of money on credit cards. We've had people that will go out and buy all the materials to do a home improvement project on the home that they're going to buy and close. They haven't even bought yet, but they rack up some credit card debt. But bottom line, when you're in the process of getting a loan, whether that be a 30 to 60 day process, we would highly recommend that you don't take on other credit obligations. Again, it just depends how tight your debt to income ratios or payment ratios are, but definitely something you wouldn't want to, if you're going to really go out and buy another car, you should talk to your lender prior and make sure that it doesn't affect your payment ratios in an adverse way.
Which gets us to number 4, thou shalt not spend money you have set aside for closing. So you don't want to spend your down payment money. Correct.
I mean, when we're looking to qualify you for a loan, we're going to, of course, we need to verify that you have adequate funds to close. That'd be your down payment, your closing cost, and then, of course, your prepaids, which would be taxes and insurance, that type of thing. Bottom line, we have to determine that you have adequate funds to close, and then, of course, we need you to make sure not to use that money for anything other than this house purchase that we're working with.
And he's already touched on going out and buying things for your home prior to getting your home, and that includes furniture. You don't want to rack up any credit card debt that's going to change anything without talking to your lender first.
Totally agree.
And if your lender looks a little frightened, it's probably not a good thing. I know I've had several times in the past where they're like, okay, you have to turn that down. You have to say, listen, I can't do that right now, and reverse what you've done. Thou shall not originate any inquiries into your credit, which is like getting new credit cards.
Correct. I mean, I think if you're car shopping, house shopping, I think, once you determine what your credit score is, I'd like to think that you're not still out shopping, so to speak, for, and having people run credit. The great thing about our credit industry today is that the scoring is done by a computer model. And I've been around long enough when we didn't do it that way. We had to do it manually, so to speak. And personally, I love the computer models because it takes all the human element out of it. And I think it ultimately gives us a better decision. But anyway, bottom line, you don't want to have a lot of credit inquiries. You should know about what your credit score is. And then when you do the person to finance with, then of course they have to run credit. But it doesn't, from a computer model standpoint, I think it confuses the model when you're, quote, car shopping and you have 5 inquiries to buy one car. It's like, what are we seeing why can't this person get a loan? So I think it brings up questions to the model. And again, I think, I'm not sitting here scared of people having too many inquiries, but I think from a consumer standpoint, you should be smart about it and only inquire about your credit when you truly are getting ready to get a loan.
Number 8, we kind of touched on last week, but let's hit that again, and that's thou shalt not make large deposits without first checking with your loan officer. Can you explain why?
Well, I think the key there is, I don't know that it really wouldn't bother me that somebody makes a large deposit, but I think the whole key is we just have to be able to document any type of deposit that you're making. I mean, I'd like to, when we're trying to verify your money. So let's say, for example, that you're pulling money out of a mutual fund for your down payment on your house, and let's just say it's $30,000. Well, that's not a problem. I mean, to pull money out of your mutual fund and deposit it in your checking or savings account in preparation of closing for your house, but just be prepared for us to ask you where the $30,000 came from. And, coming from your mutual fund would be, be a great way to, document that money. Or what we see a lot of course, is when people are selling a house and they walk out with their equity and they go deposit their equity, say another $40,000 they deposit in their checking account. We're going to say, where'd that $40,000 come from? And you're going to give us a copy of your settlement statement, and we're going to see where the $40,000 came from. So really, I don't think anybody should be afraid to do normal business. They should do normal business. Just be prepared for us to ask questions to document and support any and everything we do. I mean, if you deposited $30,000 cash, we're going to have a lot of questions, and that could potentially be a problem. So, bottom line, I think just use good judgment and know that we're going to always inquire about where the money came from. Your paycheck that's automatically deposited every 2 weeks or every week, whatever it is, I mean, that's just normal stuff. We're going to expect that. It's just the unusual bigger amounts. You sold a car, or you sold your house, or you got money out of your mutual fund, or, if you got money as a gift from somebody. We definitely want to know those things because we handle those differently.
And whenever you do gifts, you do gift letters, right?
Correct. So like if you're getting a gift, and it's really a common practice. So when you're getting a gift, there's no problem getting a gift. We just have to document the gift so that we know where the money came from. And of course, we want a blood family, or we want a family relationship with that, so to speak. And we want to know that it's not a loan, because if it's a loan, we need to figure it into your repayment ratios. I'm trying to think, but yeah, if you're getting for a government loan, the gift, you can get your total down payment and all your closing costs gifted to you. For a conventional loan, we need the borrower to have a minimum of 3% of the money be theirs, and then the rest can be gifted. Or the other rule is, if the gift is 20% of the purchase price transaction, so to speak, then of course that can be 100% gifted if it's 20% plus. But we definitely want to know who's gifting you the money, and want to make sure that there's a relationship there, a relative relationship, and just to verify the money being accurate.
So, number 9, I never have truly understood, so I'm excited you're going to explain it, but thou shalt not change bank accounts.
Changing bank accounts. I don't know. I think the real key there is we need 2 statements from every account that you have, 2 monthly statements from your checking and savings, so to speak, so that we can, I'm not saying that'd be a huge problem, but obviously we're just going to have to get more statements, and we need to track the money. So you're closing out with bank XYZ, and you're opening the same deposit up maybe with another bank, and we're just trying to always track money.
And then number 10, thou shalt not co-sign a loan for anyone.
Well, and here's the thought on that. And everybody who co-signs a loan, it is a very serious commitment. And basically, when you co-sign a loan, you've basically agreed to take on that liability in the event that you need to. If the person you signed for doesn't make the payment, that you will. So it will show up on your credit report as a liability, and you really need to be careful because if we've had people that you've co-signed for, so to speak, not make payments, and it can hurt your credit. So bottom line, when you're co-signing a loan, all I'm telling people is take it as a very serious obligation, and that 1, yes, you are liable, and 2, it can affect your credit report, and 3, it does go on your credit report. It'll show up as a contingent liability. Well, we'll have to interpret. We can look at the credit report and tell if it's co-signed, but we will count that in the person that co-signs. We will count that against their future payment ratios if they want to apply for credit.
All right, so let's discuss people that have no credit at all.
Sure.
How do they build credit? What lines can they put into that? What gets them there?
Well, in a perfect world, everybody would have credit scores and they'd have history and it would all be easy. Well, it's not a perfect world. And people, particularly young people that lack credit experience, they might come to us and not have any history at all. And so what we do in those cases is we can build a credit file. And there's several things that we can look at when we're building a file. The real key is we would like to have 4 account references, and we'd like for each of the accounts to have a 12-month history. So you might say, what would work? Well, a landlord, verifying rent would work. Utilities, electric, gas bills, cable bills, internet bills, those would work with a 12-month history. We've dug down on a few people as far as auto insurance, cell phones. Those are pretty much what I'm thinking of for how we could build a file. Or occasionally you'll run across somebody who's had loans, but the bank didn't report that type of loan or doesn't report at all. So, we can go back. The real key is for us to try to build a credit file for you. We'd like to have 4 references with a 12-month history. And I know occasionally at our bank, for example, we've loaned people money just so they can build a credit history. And a lot of times we'll do a $1,200 loan, set it up for $100 a month, so to speak, and just give them some opportunity to build some history. And what we tell them is, while normally we tell people to always prepay, it's good for you, so to speak. And in this case, when we're trying to build credit, we tell them not to prepay because the intent is to get a 12-month history on that account so that we can build credit for you. So I think, that's how we would build a credit file, and it does take a little bit more effort and it does take a little more time. So if you're thinking that you want to buy a home and you haven't started the process yet, then start by building your credit file. Get those 4 references to us with the 12-month history and give us 30 days to get that into the credit system so we can start building that file.
And as Dave Ramsey would say, your credit score is really a debt score. So you have to have debt in order to establish and have a history showing that you've made payments. So if you pay for everything in cash, this ends up affecting you also because you haven't established the credit lines.
Yeah, that would be true. We rarely do we see people, other than really young people, yesterday I looked at an account, the person had 2 credit histories and this is probably a 20-year-old person with 2 histories, one a car loan and one a credit card, and they had a low 700 credit score. So I thought that was a really good score for such a young person with such limited credit history. And so that would have worked nicely for going forward. More commonly, though, that person might not have any score, and just because they don't have much history, and that's when you need to build a file. But bottom line, credit, it's really an important aspect.
Okay, so now we're going to explain different types, or actually he's going to explain and I'm going to listen, different types of loans. Let's touch on fixed rate mortgages.
Sure. Well, Karey's put together a great list of all these different loan types, and we're really glad to be able to go through them, and proud to say that, everything on the list we've done. We've actually got a lot of good experience with all of these items. And the great thing, our job as a loan originator or loan officer is to take an application with an open mind and not have a predetermined idea as to where we're going to place that loan. But our job is to know all of these products inside and out so we can take an application and then put the person in the right product. Now, there's really no one right product for everybody. It's not like one product is the best thing for every single transaction that walks in. And the great thing about the way we, like a lot of lenders, have so many different choices and products that it's really a great thing for the consumer. So again, no one right product for every transaction. And the key is for a good loan officer should really know all the products and all the options and be able to put that person in the best product and for them. And the real objective for us and most lenders is to always put the customer in the best product that they qualify for. So starting with that, the first thing you're asking, I think, let's just talk about fixed rate versus adjustable rate loans. Well, when interest rates fixed are in the 3 to 3.5 range, so to speak, that's a really attractive product. And if a person qualifies for that type of product, we would normally think that's the best product for them to be in. Occasionally, we'll have somebody that wants to look at an ARM, for example. They'll want to look at an adjustable rate mortgage. That's what ARM stands for. And they'll want to look at an ARM, and they might want to look at maybe a 5-1 or a 7-1 ARM. And what a 5-1 ARM means is the rate's locked in for 5 years. Then after that, it adjusts every year for the remaining term. So if you did a 30-year loan as a 5-1 ARM, it'd be fixed 5 years, then adjusted every year for 25 years. And, the only logical way I could think of a person wanting that product is if they said, you know what, I'm going to be moving in 3 to 5 years and I really just don't need a 30-year fixed, and I'm very confident that I'm going to be moving, so to speak. Then I guess truthfully as a loan officer making a recommendation of product, then I can't argue that. Maybe that is a good product for you. But for most people, they like the assurance of a 30-year, 15, 20, 30-year fixed and the known principal and interest payment. I like to tell people when they're getting a fixed rate, 30-year loan, so to speak, that the only thing that will ever change their monthly payment is the taxes and insurance as they go up, so to speak. So it's really nice to have your principal and interest fixed, and probably 99% of what we do is a fixed rate loan, and probably what we recommend unless you have a really good reason for getting into an ARM. Now, there really are two different types of loans that people get on houses in my mind. There's mortgage loans, and then there's bank loans. And bank loans typically do a lot more of the adjustable rate mortgages or balloon loans. You have balloon on the list here too. And the reason the banks do that is because it ties in better with their source of funds that they loan out. I mean, most banks have deposits that range from, checking accounts, so to speak, to 5-year CDs. So they're going to be financially comfortable giving you a product that would, make it a good match. Bottom line, that's a common bank loan is to get an adjustable rate or a balloon because it matches up with their source of funding. I'm not a big balloon person. We don't promote balloons at all. And the reason being is that if you have a 3-year balloon with a 30-year amortization, what that amounts to is you have a loan that matures in 3 years. So at the end of 3 years, you have to do something with it. You have to refinance it or pay it off. And personally, I I don't like it for several reasons. One is like if that happens to be a really bad time in your life from an employment standpoint or a credit standpoint or a health standpoint, it might be hard to get it refinanced, and it might be hard to pay it off. So I kind of like a loan where if I'm making the payments, I don't really need to go through the exercise of redoing the paperwork. And that's where I would prefer an ARM over a balloon. But it is common to do balloons, and that's probably because it matches up best with the lender's deposit source. In other words, they can match it up with CD money, so to speak. Anyway, not a real big balloon lender. I really can't recommend that product. We do a lot of ARMs that are what we call in-house bank loans, and that would be for a loan that really won't qualify for a fixed rate loan. We always promote the fixed rate unless the particular product or situation of the customer doesn't allow that to become true. So like, for example, rental properties. We have so many limitations on what we can do from a fixed rate rental property loan, like primarily meaning that we can only do about 4 fixed rate loans for any borrower. So when you get beyond 4, then we're always going to be looking at ARMs. And, so I think that's a good use of an ARM. Or a lot of times we'll put somebody into an ARM for a loan that we need to season a little bit before we refinance them into a fixed rate. So anyway, I think hopefully that clarifies some matters on the fixed rates versus the adjustable rates and the balloon loans. Interest-only loans, we're not seeing that product as being a very common thing anymore. Obviously, that happened a lot, you might say, in the mid-2000s, and it pretty much went away in 2008. The only real interest-only loan that I can think of right now would be like a home equity line of credit, where you do an interest-only based on the balance you have outstanding. And then, of course, if you're in a construction loan, you might pay the interest every month, so to speak, on something like that. But really, for somebody to go out and buy a house and for a 30-year term, so to speak, and think that 5 or 10 years they're going to have interest only, I just don't see that product out there anymore. And I really don't, it's probably a product that got us into a little bit of trouble back in the 2007-8 range or prior even, because I guess, so I can't really recommend that product.
So basically, we are out of time again. We're going to have him back on because there's a whole list of things on here that we were going to discuss today. And there's just a whole lot to learn from the lender's aspect.
Well, thank you. We'd love to come back. We'll love to keep talking about this. It's enjoyable.
So if you would like to get a loan, give Dave Hill a call. Anyone from their bank is great. Again, Sherry Hensiker is here. She does Topeka and great to work with. Their office phone number is 785-841-8055. Check them out on the web at www.mid-americabank.com. And if you would like to buy or sell a house, give us a call at 785-783-4010. Check out our website at www.topecahomeadvisors.com. You can also check out our rentals at topecarents.com. And we would love to help you out. Shoot us an email at kareybrowntteam@gmail.com.
Thank you for listening to Real Estate 101 with the Karey Brown team from Realty Executives Preferred Advisors. Tune in again next Sunday at 11 o'clock for Real Estate 101.